Well, hello, everyone. How are you? Good. Get some thumbs up. Thank you, Patrick. Great to see you. Wonderful. Oh, Hugh, awesome. Karen, Maureen, great to see you on here. It's so fantastic. And for those of you who are joining us, broadcast anywhere, this happens to be great to see you all out there as well. So my name is Jennifer Hunton. I'm the Chief Intelligence Officer with the Real Estate Wealth Lab, and you are joining in our Market Leaders Lab today. Very exciting. And we've got, we were expecting, and Naran is here. Perfect. And Naran is joining us. He is our Chief Leadership Officer. So we'll get him spotlighted too. And I will just share my screen. We were going to have, Naran, actually, can you, yeah, there you are. Awesome. Very cool.
Perfect.
Welcome,
How is everybody? How is everyone? You're good? All right. Now I'm seeing people giving me thumbs up. Awesome. So as Jennifer was saying, hey guys, you know what? We've got stuff going on, and what took place was we just had to, summer and stuff happens and we had to rearrange one of our speakers. And so this is the day when Jennifer and I are jumping on board and presenting for off the cuff. Now, here's what happens. Listen in. Here's what happens. We start giving away stuff where we were not intending to give away by doing this. So you're going to get all kinds of nuggets, stuff, insider secrets that I would never tell anybody. It's probably going to spill out today.
Wonderful. And what we're going to be talking about, who here is interested in either multifamily, do it yourself, or investing in a REIT of some sorts or something along those lines, or a fund that has multifamily apartment buildings in it. Pop it in the chat, thumbs up. Who would like to invest in? Yeah, great. Yeah, okay, good. Well, it happens that, excellent, thanks folks, is that Naran and I are both well, let's see. We've been investing in our own apartment buildings since I think my first one I bought in 2013. So up to 50 doors, and we're going to be talking about that today. So before we get into it too much, I do want to quickly share a welcome to those out there. We're in it to win it. A little bit about the Real Estate Wealth Lab. Actually, you know what? We can do that just at the end, but we have a little bit of housekeeping that we need to do, and I'm pretty excited. So if you'll just bear with me for one moment. So huge welcome from us, and this is the rest of our REWL team, lots of us and lots of folks behind the scenes who we're very grateful for. And with the Real Estate Wealth Lab, you get weekly reports and expert commentary, macro market trends with a lot going on. And don't worry, we will be, by the way, our guest speaker, I'll go through it in a moment. She is being rescheduled. She's coming on in September, and it's really important to get those macro market trends that's going on right now, especially when it comes to interest rates. And I am just going to go through this really quickly. What I want you folks to know is that you need to save those dates. We hang out on the 2nd, 3rd, and 4th Wednesdays of the month. Great to see you, Terry. Thanks for turning on your video always. And here's your save the dates for the next little while. So I'm going to share a little bit about what's going on. You're here right now, and the next community lab is next week, next Wednesday. Members of the REWL community, please come out. We are going to continue the conversation that we had last month about designing our brainstorm, our boardroom, how we can, and our community and how we interact. So that will be very interactive and really, really important to get your feedback, because we're building on our last conversation. So I'm super excited about that. That's next Wednesday, August 17th. And then our research lab, please, I hope you're able to type or share, because for our research lab, it will be, sorry, it's not August 17th. I got the wrong date in there. It's August 31st. My apologies. What city or market would you like for a city analysis? Pop it in the chat, and we will be very democratic. First one to pop it in the chat, we get to choose. This is for our members. Whatever city you would like us to look at next, we will do that for you for Research Lab. Atlanta, Georgia, Hugh. All right, that's the winner. Fantastic. So there you go. You get a personalized, well, not personalized, but this is what we do for our Real Estate Wealth Lab members. So that's awesome. We will be doing Atlanta, Georgia. Thank you so much. All right. Pays to be fast. And then our Market Leaders Lab, we're going to have our next one September 14th. And I'm really, really excited that Carmen Campanero of Pro Funds and Valor, she will be joining us. She's also a TV host of the 30 Minutes to Wealth TV show. And she's an amazing, amazing, super professional, very accomplished real estate investor, mortgage holder, fund extraordinaire, you name it. But in addition, I have been working with her since I think 2010, so about 12 years. And I can tell you that Carmen has earned my respect, and I cannot wait to share her with this community as well. So that will be September 14th. Yeah, buckle up for that one for sure. And of course, the rule book. This is for those of you who are just joining. We're going to talk more about that later, but I'm letting you know that this is all ongoing. And of course, we do have our continued promotion for our free trial, which is right here. You can scan it. But as we promised, we're also doing our member, basically a free membership. Who doesn't want a free membership? Yes, you all want a free membership. So this is a value of $1,188 of an entire free year of REWL membership. And we're going to spin here for a winner. So are you guys ready for this? Are you excited? I'm excited. Excuse me. I am excited. Okay, so I think I can share. Oh, I want to share my screen. I'm going to bring this over here. Can you see this?
We're good.
Yes. Awesome. Okay. All right. Here we go. We're going to spin the wheel, and our members, whoever is going to be the winner, we'll have to make sure we record this. Maureen Roach, right on. Congratulations, Maureen. You are the lucky winner of 1 full year to hang out with us. I'm so excited. That's awesome. Congratulations. Well, we'll be seeing you around then, won't we? That'll be so awesome. So thanks so much. I'll just get rid of that.
Right. And Maureen is in the room right now.
Yes, she is.
So congratulations, Maureen.
Congratulations, Maureen. Oh, look, she's smiling. Oh, that good. Awesome. Right on. That's what we like to see. That's great. Very cool. Okay, so there you are. Now, we promised that we were going to do this 3 times. So our next one, so we've had 2 lucky winners so far, and our next lucky winner is going to be at our Market Leaders Lab on September 14th. So do come out to that. And just again, getting into our content today, our disclaimer is that it's just a normal legal disclaimer that if any of this sounds like, forward-looking information or opinions or anything like that, this is really not a substitute for the advice of a qualified licensed professional. So you need to do your own complete diligence. This is being recorded, and it will be played publicly, and it will also be available in your REWL member portal. And again, the chat rules is please engage, ask questions. This is going to be a Market Leaders Lab that's going to be very not informal. We've got some let's just say we want to be fluid. We want to take in your questions, your answers, and we're going to answer them the best we can. Say hi, engage. And like Hugh already did, popping it in the chat first, he's got this market that he wants. So definitely share your feedback, and then please just don't solicit or sell. And otherwise, we're just going to hang out. So let's get into some multifamily. First of all, so Naran, let's just have a quick, before I do some before and afters, tell me a little bit about multifamily and why you invest in multifamily.
Well, Jennifer, there's a lot of excitement in talking about multifamily, but I'm finding that very few people actually go out and do it because there's this fear factor around it. Like everything is so much bigger in multifamily, not just the size of the building, but the amount of capital you need and the amount of finesse you need in your ability to manage and to raise the capital, to place it properly. I got into multifamily really, my first deal was, it's because I had hit a financing wall. I had too many doors under my name, and there was a financing problem. And then I thought, I was told that if I set up a corporation and went to a multifamily, it was easier to finance. The banks would look at me differently. And so I actually, I spent a ton of money, and I flew to a specific course on multifamily, came back and then did a bunch of learning. And then that built my confidence. I went and bought my first multi, and I haven't looked back.
Yeah, that's awesome. It was very similar story. And I love this. We're basically, sisters, brothers?
Yes, twins. Would you believe it?
Siblings. Because that was very similar to my story also, is, got in early into real estate and then recognized, first of all, getting that capacity in terms of financing, and that banks look at multifamily very differently. They look at it as a business. So you're qualifying more primarily on the building itself. So same thing there. And also the economies of scale. For me, it actually felt, I know it sounds strange, but it actually felt less risky to have a multifamily apartment building than it did. Oh, good. Danielle loves multifamily too. Cool. It felt less risky because one tenant and one roof, your vacancies are bigger, if a problem occurs, et cetera, that's a challenge. Whereas for me, and many of you are getting to know me, if you don't know me already, is that I like to mitigate risk where possible. And actually multifamily felt like it was doing that. So, and it does, because if you get one vacancy, it's out of a 24, unit building, for example, you've only got 1 out of 24. So it's like, that's pretty manageable. So that's where I got into it too. And then, go ahead.
The other thing I want to mention is that I've also noticed that people that get into, now this might be just my experience of it, but some people that get into multifamily, and myself included, I wanted to be a big player. I didn't want to stay small. And I noticed that all the big players were eventually ending up or leaning into the multifamily space.
Yeah.
And so I thought, well, I'm going to do the same thing.
Right
What
on.
could
And
possibly go wrong?
What could possibly go wrong, right? Well, we'll have some stories about that. I'm certain of it. But also I wanted to mention that whether you're from your like the hat of do it yourself, like let's say, Danielle, Hugh, you're interested, you want to do it yourself and buy a multifamily. Or if you don't want to do it yourself and you want to invest through a REIT or a fund that has apartment buildings, you still can listen to this presentation and what we're talking about today, because you'll be wanting to evaluate whether that REIT or their business plan, their value add strategy, or whatever their business plan happens to be to increase the value of that apartment building, if it's going to align with you, if they're doing it right. So you'll be able to be armed with the right information. So again, if this doesn't appeal to you of like, oh my gosh, I want to go out and look at these pictures, I'll show you in a sec, and do multifamily, that's okay, because you're still going to be armed with information that you can evaluate effectively.
And Jennifer, just so that we situate this call, this chat properly, with regard to multifamily, there's those two, do it yourself first, and the people that want to invest in REITs. I've also found a third position on that, and that's the middle position. And I found that, like a lot of my investors that work with me, they join me not because they want to do it themselves, but they also don't want to be completely hands off. So they want to learn and coach. And so what ends up happening is that they start partnering up with me because they want to be in the trenches, but they don't want the responsibility right now because of time and all kinds of different reasons, right? So I carry the responsibility, but they have the experience.
absolutely. And that is fantastic. And a great way to partner if you're just getting started in multifamily is to partner with someone with experience. And same Naran, most of my joint venture partners in multifamily have been individuals who are, I want to be in it, but to start, to begin with, that's a lot. So then we can, coach and teach aspects of it, but it's not, do an analysis of this component as opposed to doing the analysis of an entire, renovation project, for example. So it's a great way to get more than your toe in, get your foot in, but not have to be completely on the hook and responsible. So that's fantastic.
So Jennifer, tell me a little bit about this slide. I'm noticing this is interesting.
Yeah. Okay. So again, it really depends on where you want to be and the do-it-yourselfer and the not do-it-yourselfer. But Naran, I know that you and I apply a very similar, and we'll talk about yours in a moment, but a very similar value add strategy. So I'll speak for you and then you can correct me, or maybe I'll speak for myself and then you can say if that fits yours. So I've typically bought poorly managed, very poorly managed properties, let's just say that, that are kind of more like C-class buildings, like not super great classes of assets, in tertiary markets, sort of secondary markets, tertiary markets, so a little bit further out. A primary market, for example, would be a place like Toronto. Secondary market would be even further out, and like Chatham, Ontario. Tertiary might be Sarnia, Ontario. That's kind of how I'm looking at it. So I was in secondary and tertiary markets, and they needed a lot of help. Like, not just were they underperforming, poorly managed, but they also needed some renovations. And this is where there's a lot of opportunity. And so now, when I first started, I did some of the renovations myself. And with my business partner and husband at the time, and absolutely did a lot of this kind of thing. Now, I don't know that I would necessarily want to do it at this kind of in the trenches level, but I wanted to show you a little bit about what this property looked like. This is a 24-plex that purchased in around 2013. And as you can see, this is what it looked like. Not so great. And like, this was the kitchen, not so beautiful, really. And then this was the entrance. I mean, look at those mailboxes just on plywood. The doors were terrible, you name it. Look at the stairwells, really run down, and not a beautiful community in which to live. And so this is just a quick little video, oops, pardon me, of some of the changes. So paved the parking lot, painted the parking lot, painted the exterior of the building, all brand new doors on the exterior and windows on the exterior. You can see here in the middle video here, all these brand new, top rated doors, totally beautified the inside with proper flooring and better stairs, and mailboxes that were secure and doing things properly there. And then right into inside each unit. Oh,
one of our completed one-bedroom.
So inside we've got a completed one-bedroom unit, all the paint jobs and the cleaning it up and actual, moldings and baseboards and heaters and new appliances and renovated kitchens and renovated washrooms. So it's a beautiful suite with that's light and bright. And this is where you get to, as you know, Naran, this is where you get an opportunity to look at and putting in in-suite washers and dryers and all of these impact. Look at that. Oh my gosh, compared to what it was. Super proud of this project. And by doing that, you can raise rents, and you create a better class of asset. And you increase the value, which we'll talk about in just a moment. So Naran, how does that work? Is that something that works for you? Is that what you do too?
Similar.
Okay.
What I found, Jennifer, is that you have to go with what you're strong at. So I am really good at drywalling and plumbing and electrical, but it will take me 25 times as long for me to do it than for anybody else to do it.
Yeah.
What I found is that I looked at my skill set, and what I'm really good at is knowledge management, like being able to know the information, know what to apply. And one of my strengths that have always shown up consistently is leadership, the ability to lead myself and to lead others. So I thought to myself, how do I leverage this? So when I go into a multifamily, I do not want to pick up a tool. I do not, I refuse to pick up a tool. I do that in my own house, but I will not pick up a tool. I don't, like in my multifamilies, I usually visit them now. Like there's 3 buildings right now that I'm in the process of turning over or, making better. So about once a week, I show up on site and I make a list, like look at what the next stage is. So what I'm good at is the planning and the process. And then I outsource and manage all of that.
May I just interject here, Naran? I should have been more clear in that. Is I took those pictures, and yes, I did some renovations in the very early stages to get a sense of what it was going to take. But no, correct. Like, get your competitive and comparative advantage happening for you. And I am not that person. So all of that was absolutely outsourced, but I did want to get a sense of what it took. So thank you for that clarification, Naran. I concur. Awesome. Okay. Well, share a little bit about some of the key things about what you need to think about when buying a multifamily. And these are just, we're going to go through a few slides and then we're going to take this off and we're just going to have questions and answers and we're going to chit chat. But I wanted to give a base and some context. So of course, as always, in terms of multifamily or any real estate, start with your market research. Where are you looking and why are you looking and all of those things. Having a power team, and a power team with a multifamily is even, all of them, it's always important, but we're going to talk a little bit more about what that power team looks like today and how to manage that. Finding a property, how to, of course, and then property analysis, and you get into the actual property analysis, like is this a good multifamily or not? An offer, the diligence during the offer. And by the way, just to give you some context, because we've only got about an hour or so today, there's a presentation that I've got just on the offer that is a full 1 hour, step by step and the timeline. So just to let you know, we're starting at this 30,000 foot, and always happy to share a further information. So then diligence, financing, closing, and then manage for profit. So that's your how to step by step multifamily. However, each one of those, if you double click on that, there's a lot more behind it. When it comes to market research, as you know, you'll want to continue with your real estate wealth lab city market analysis is a place to start. So Hugh, you're ready to go for Atlanta, Georgia. We'll let you know how that's doing at our research lab in a couple of weeks. And of course, you're looking at those economic indicators, et cetera, et cetera. You can, rely on our research here at REWL as well. But then you want to definitely get down into the neighborhood, like always into the neighborhood. Who are your tenants? What kind of tenant profile? What's it? Is it being gentrified, revitalized? And then we're going to talk more about capitalization rates in just a moment, because that's something that's very important and often, confusing maybe and confused. Yeah, so we're going to unpack cap rates. And then you want to look at your market rents and typically a price per door. So that's kind of some of the main areas that I would you agree, Naran, that this is really like the main stuff that you look at for when you are looking to buy and acquire a multifamily?
Absolutely. This is the main stuff. What I want to caution you is that, not you, like all of us together, is that, like Jennifer said, we can take every one of these things and we could do a 5-day course on it and still not fully grasp everything in it. It's the deep well. So yes. Today we'll go deep on a couple areas, but and then give you an overview of other ones as well.
Sounds good. All right, so let's do it for a cap rate, because who here has heard of the word cap rate out there before? Capitalization rate, yeah. Okay, so the definition really is that it's basically your rate of return. It's your, it's kind of like your ROI if you were to purchase that property with cash is essentially it. However, what's often kind of missed in that is it's kind of like it's based on risk. So for example, like if you're going into a risky stock or something like that, you're typically going to get a higher return on investment. And it's kind of the same thing with a cap rate. So your asset class, your asset location, those all affect your cap rate. So for example, in an A class, in a tertiary, so in a tertiary market, it is going to have a higher cap than in a primary market. And we're going to show that in just a moment. So how do you calculate it? Naren, do you want to share how you calculate the cap rate?
No, you go ahead with the cap rate.
Oh, okay. So it's just, yeah, sure. Of course. Yeah. It's your net operating income. So that's basically just, your profits, your revenues minus your expenses, not including debt service. So that's an important component, divided by your purchase price. And so essentially it's just your ratio between your NOI, your net operating income, and the market value, the fair market value. So that's perfect. Okay. I love this question, Vincent. Sorry, go ahead, Naren.
No, sorry, I was just going to say that with the cap rate, I haven't seen Vincent's question yet. So, hey, Vincent. But with cap rates, it's one of those things that I find gets really messed up in the market. When you're a new investor, you hear this word cap rate being thrown around, and then once you've been in the field for a little bit, I'll notice young investors walking around throwing out cap rates. But it's better felt than told. It's a number that can mean and point to multiple different things at the same time. So, for example, some of you, if you're a science geek, you will understand that the speed of light is constant, or Avogadro's number is constant. Well, cap rate is like a constant, but it's constant only in a specific time and in a specific area. So right now, for example, like I was looking at cap rates in Kitchener-Waterloo, that area, walk-up apartment buildings without an elevator, B class, and a B class means everything's not perfect, but just a B class building, walk up. They were trading around 4% cap rate is where they were. The financing lenders were looking at it. They were trading 3 months ago at a much lower cap, but when a lender looked at it, they would look around 4%. Right now, what I'm finding is that because risk in the market has increased, or perceived risk has increased, the cap rate has also pushed up a little bit. So if we come back to Jennifer's net operating cap rate formula of net operating income divided by purchase price, if your cap rate has come up, it means that the value on the building from a lender perspective has actually decreased a little bit. Make sense? So it's think about it like a mathematical formula, and when one increases, the other one decreases, or vice versa. Like for example, I live in outside of Toronto, and so in downtown Toronto, you're going to get really, really low cap rates. Why? Because more people want that market, and those buildings, because it's perceived that the risk is lower in Toronto. Whereas if I went 3 hours north of here, my cap rate could be 7, 8, 9%, but the perceived risk is higher because you don't have the same economic drivers to drive it.
100%, Naren. And that is, I'm going to switch the slides in just a second, because Vincent's question in the chat speaks to this also. Is a high cap rate better than a lower cap rate? And I love the answer
Great
to
question.
that question. Is always, it depends. So, and it really depends on you and your level of risk. And so I love that you were sharing that, because this is a little bit of some benchmarks, if they appeal to you. And I love benchmarks, you know me. So what happened, I got a little story. So I'll just run through these, is that, like, greater than 10 cap rate, like you were saying, young or new investors around, be like, yeah, I got to get a 10 or plus. actually, maybe not. And go ahead, Noreen.
I'm just going to interject something here. And just if you're new to the cap rate conversation, higher the cap rate, higher your cash flow on paper. And I say on paper, I underline that, right? So because it doesn't
And
always
the higher the
work
risk.
out, higher the risk, right? It's kind of like, let's say you're buying a house for $100,000 with $1,000 rent on it.
Oh, Naran, I think you froze.
Did I freeze?
Yeah, you did. Try again.
Okay, I don't know what you missed, but I was saying that if you buy a house for $100,000 and you have 1,000.
I guess he's not. It's that analogy isn't going to work, Naran. So I'm going to carry on. And so what we're getting at when we're talking about risk, and I really wish that someone had mentioned this to me when I first started. But I figured it out. And so I'm going to give you a little lesson in a story, if you will. So when I first started out in the educational programs that I took, they're like, you have to get a 10 cap or bust. It's like, oh, okay. So like, that's what I was looking at. And that's what you had to do. That was it. So in reality, I want to give you these benchmarks is like, yeah, greater than 10, you might be awestruck, but there is a reason for that. And that's that risk. And I'll share that in a second. 8 to 10, amazing. But you'll have to prove that. And again, what kind of underlying risks are pushing up that particular cap rate? Because it's really, it really is just an evaluation of risk. 6 to 8 is more your reality in tertiary markets. 4.5 to 6 is a reality, and Naran was just explaining a 4.5 to 6 is a reality in a secondary market, and 1 to 4.5 is a reality in primary markets, and that's okay because in a primary market like Toronto or Vancouver, maybe you only want a 1 or 2 cap because you're preserving wealth. And that's all right because it's just a different strategy. It's a de-risking in terms of the market. So and I'll share a little story about when I first started, found a property, a multifamily apartment building. I will not share where it was because I don't want the poor town to, anyway, but it was a tiny tertiary town in the middle of British Columbia, nowhere. But it was a 13 cap. And remember, I'd been instructed 10 caps only. So I found 13. This was super exciting. Started to do some diligence. Now, thankfully, I had some smarts on me, but that was about it. I didn't have the real estate wealth lab market analysis. I didn't have these processes in place, but I at least started to do some diligence because at a minimum. And I was like, this is interesting. It's a very small town. How many employers are there? Well, there's no market research for this small town. So what I ended up doing is I found out that there's really only kind of like one main employer, and it was a mine. And I actually called up the mine. Yeah, back in the days of the telephone, picked up the phone, called the mine, and I did some research, of course, about it. I asked them, how many years do you have left on your mine reserves? And they said 13. Can you imagine if I had bought a multifamily apartment building? It was 40 units, green, brand new, like fresh thinking about multifamily. And there was only 13 years in the mine, and that's the only employer in this town. So this is why it had a huge return on investment, but it wasn't going to last. So that's where we want to start picking and looking at cap rates quite differently. Hey, Naran?
So Jennifer, I want to say two things about your illustration. First, it tells you, boys and girls, and all other endangered species here in this call, the type of research person Jennifer is. Like, you actually called, and you didn't call and ask, hey, are you in business? You asked a very, very specific question that was a leading indicator answer, right? So and learn how to ask those questions really well. Like, the questions really are crucial to helping you get the information you need. Secondly, in today's market, if you came to me and said, hey, I have a building that's presently a 13 cap, do you want to buy it? I would tell you to run.
Me too.
Because what that means to me is that that market is so, nobody wants it so much that the price is so low compared to the rents. Nobody wants to take on those headaches. So
That's
I would
right.
be running.
And you know what? If you get nothing else out of today, I think that that is a huge lesson. Like if it's a 13, you might be awestruck or you might be running or, you know, in the other direction, and at minimum doing some major market research and also mindset. Because if you're dealing with a 10 plus cap rate, you need to be prepared to handle some different kinds of challenges. Hey?
You're going to be collecting rent with the gun.
Oh my gosh. It's quite
Oh, did I say that
potential.
out loud? Sorry.
I don't believe it is, and we don't, yeah, so safety first, but yeah, so we're going to shift gears a little bit. Any questions, any more questions on cap rates? We're going to open up the floor in a moment, but anything immediately on the cap rate? Okay, all right. And please feel free to ask questions along the way. Nito, I see that you asked a question about the minimum considered, sorry, what is a considerable minimum number to be considered multifamily? I think that you're referring to the number of units, and it's somewhere around 5. It depends on the financier and the financial institution, and I will address that in just a moment. So thanks for asking that question. Yes.
Jennifer, before we move on from cap rate, there are
Sure.
2 things just to mention. One is there are actually 2 different cap rates for any building. There is the market cap rate. In other words, what are buildings actually selling for? And the other is what cap rate is the lender using? So in a market that is climbing high fast and lenders are being conservative, they're going to use a higher cap rate than what the building is actually selling for. So you want to find out what is so the first question is, what are buildings selling for? That you ask a good realtor, and they should be able to tell you what cap rates approximately that they're selling for. But to find out what the lender is selling for, what I often do is I go to CBRE, puts out a market cap research a document, and they will actually identify for you different areas, different cities, the type of asset, whether it's over 4 floors, whether it has an elevator, no elevator, the type of class, and what range of cap rates they're using. They'll give you a range. So for example, if the range is 4 to 5 for a specific type of building, let's say it's a 4-story walk-up 16-unit building, range is 4 to 5, the lender will use 5% to calculate their lending value if the building has a lot of maintenance issues or has tenant problems. Like if it doesn't look right. If everything is showing really well and you can provide 2 years of invoices or even 3 years of bills to show a consistency of the net operating income, they will use a lower cap rate. So there's a lending cap rate and a purchasing cap rate.
That is awesome pro tip stuff, everyone. I hope you were taking notes on that for sure. There are so many nuances, and that was just one key performance indicator too. So, well, yeah, thanks, Moran. And lots to apply as well. Okay, so shall we switch gears to Power Team a little bit? Not much to add here, except for, it's the same as what we would do for any other property, except they need to be specialized in commercial deals. There's absolutely, like, they have to understand the commercial market, the corporate side of it, the business functions, the financing functions. Everything operates differently in the world of commercial real estate, which is multifamily greater than approximately 6 units. And I would say you always want to have good relationships with all of your power team, and you'll want to manage them even more closely because there's just so much more going on. There's so much more potentially at risk, potentially in terms of, dollar values and whatnot. And there is a major, in my experience anyway, Naran, major emphasis on asset and property management. Like, my property managers are so integral to the success or failure of a particular property. Do you do self property management? You've got property managers, right, Naran?
I manage about 3 or 4 units, but they are not multifamily. They're single family.
Mhm.
And I have a very good tenant there, and it's there's no problem. But with the multifamily, property management is so crucial. And so in multifamily, the way I look at property management is no one person. I'm looking through this group here, and even Terry and Hugh. I mean, you guys aren't perfect.
Oops.
There's something that's missing in all of us. And so what happens is the same personality is in a property management company. You want to assess, is the property management good at tenant turnover, or is it good at management? Is it good at maintenance? What's their skill set and what's lacking? And you want to connect the building and what the building needs with the right type of property management company. So I use different property management companies. I will bring them in depending on what stage of a turnover the building is in.
Yeah, that is another pro tip for sure.
So the other thing, Jennifer, is that with your the team, the power team, they just cannot be good at what they do. They have to be killers. They have to be outstanding. I will work with only the best because I don't have time for things to go wrong on a multifamily. If something goes wrong, like let's put it this way. You have to change a roof on a house. It might cost you in today's market $5,000 to $10,000. You have to change a roof on a multifamily, $100,000. Do not make big mistakes. So you want to make sure that your power team, and I'm not sure how detailed you want to go into the power team today, Jennifer, but
however you want. You've also mentioned about an appraiser and how that's important. And I've got another pro tip, so I'll just pop that in here. So you go talk about the appraiser for a second.
So again, my skill set is leadership and being able to connect with people. That's one of the things that I do well. So I tend to bring the best trades and the best people I can find, and I keep them. And I do everything in my power to keep them busy. And we become lifelong friends. Just a couple of days ago, I had dinner with one of my joint venture partners. I've been partnered up with him for 12 years.
Yeah.
You want to create that friendship. So out of that, like in my power team, I don't just have realtors and all, the regular people. I have a few other people I add to my multifamily power team. I have an appraiser, and my appraiser has now become my friend. He partners with me on deals.
Yeah.
So
explain a little bit why that may not be quite so unless you've lived it or experienced it, it might not be quite so intuitive to understand why the appraiser is important. And I can tell you, friends with the appraiser and always repeat business and going back in my experience, for the refinancing after the value add is where it's really, really important. So that's my experience. Naran, how about you?
So for me, the appraiser is key because the appraiser needs to be a no BS kind of person. Because when I look at the building, when I buy it, I will tend to undervalue that building. And if I'm going to the bank and I want to refinance it, I will tend to overvalue that building. It's human nature. So I want somebody on my team who's just going to be very nuts and bolts about it and go, dude, this is your NOI. This is what the bank accepts. This is what the property's actually worth. Yeah. And then what I can also do is the appraiser will tell me, well, here are certain things that you can do to take this building to a lower cap rate. And when I know that, then I start doing that. Like I've got 2 buildings right now that we bought, in the last couple months, and already within a few months, we are painting the entire outside of the building and doing the landscaping. Why? Because I want people to feel welcome, and I know that when I do that, the cap rate drops a bit. right?
And your ability for financing. Another pro tip on the appraiser side, by the way, ladies and gentlemen, is that I think I learned this one the hard way, is that I used an appraiser that wasn't on on the financier, so on the banking institution or whatever, it wasn't on their hit list. They have a special list of appraisers that they use and only use. And so you need to get that list first and then make friends with that particular appraiser. So that's another little pro tip. And then one more that I would like to share that is, I don't understand how this is overlooked so often. I know many astute REWL members here have mentioned it. And that is your bank manager, a banker, your bank, whether it's bank manager or your bank account manager, whatever it is, because you're transferring monies and funds all the time. You're opening accounts for different, depending on if you're growing your portfolio, and each property has its own bank account, and they can make or break your life. So I highly, highly, highly recommend getting to know your banker. How about you, Naran?
And Jennifer, with the banker, it's not just getting to know your banker. If your banker is not good at what they do, go down the block to the next banker. Like, I actually did that at a Scotia bank. I actually moved from my branch that I've been with for a number of years because I got fed up with their service, moved down the road to another Scotia bank, demanded all my accounts being changed. I ran an Instagram video live right then and there. To this day, when I walk into the new branch, I am treated like a demigod, right? And everybody know, and what I like about it is that this branch has good business manager who understands multifamily.
Yeah.
So
well said. And one of my account managers, the best account manager I had, got promoted to the branch manager. So good for him. But in his place, we ended up with an account manager who was okay. However, that person's right-hand woman, if you will, she was just worked with him, but was not an account manager. Oh my gosh, she was incredible, is incredible. She's still there. She's still amazing. But the shift, because she had learned how to do all of these things that very few people in the back end of the processes that the bank had, and she knew how to do all this stuff, that it literally changed our lives. So like, highly recommend finding those gems and then making, having good relationships with them. Anything else on Power Team, Ryan?
The two things. One is with the Power Team. Sometimes when you look at, like, we think in terms of individuals, right? Like a realtor or a finance person. But some of your Power Team comes with a whole host of individuals, like a property management company, for example. There are two things I do. One is I follow the talent. I've actually changed property management companies when the key people left and went to another property management company.
Yeah.
The second thing I do is I always meet with whoever owns the property management company or the president, and I want to get to know them well, because Franklin Collins, I believe it's Frank Collins who wrote the book Good to Great. And in that book, he talks about how if you want to change a company, you change the CEO, because ultimately everything falls in line with the CEO. So I will always go to find the CEO, who's the real power person, because I know that over time, that entire company is going to shift under his personality. And I want to align myself with that. The second person that I use on a Power Team that I have never heard of other people use is an interior designer.
Oh.
I have an interior designer that I've worked with for years. I just met with her like a few last week, right? And so every apartment building, every house, I bring her in. She saved me money and made it look amazing. So always use an interior designer.
Very, very cool. That's a good one. Okay, so how do you find properties? Multifamily properties. So
Jennifer
here's
walks down the road and people just bring her the deals. That's the truth.
Okay, that did happen. Absolutely. There's, having a strong relationship with your realtor, of course, but there's less inventory out there. And so this is really where having pocket listings and off-market deals are the way to go. And one of the best ways that I have found properties beyond a really great relationship with my realtor is through my property manager. And they know other, buildings that they manage, and maybe they're, not being looked after effectively. So it can acquire those, et cetera, et cetera. So that's been really, really effective. And then also, I'll just skip down a few, it's the REWL property shop. So if you haven't had a chance to get into the REWL property shop yet, this is a really, really huge asset for our members. That you can market in there because it's a membership. So in terms of understanding what's, what the possibilities are in there, that we're a community, and so we can share our deals with each other, and that includes some multifamily. Hey, Naren?
That's right. Absolutely. Multifamilies are hard to come by. And
they say that if it's gone on to, what is it, ICX, or like the commercial listings, if it's gone on to ICX, it's probably too far. It's just like too far gone or whatever have you. So I know when I first started, I was looking on that. I mean, that's why I barely even remember the name of that listing service, because everything I've acquired or sold has just been through relationships.
The relationships are key. The other thing that I do that I've been able to find properties is I'm looking for an angle that other people have not seen or have not executed on. Lots of people have great ideas and great dreams of what they want to do with the property, but they do not execute on them. And execution is omnipotent, man. It's just like if you just did what you could do, think of how different your life would be, right? So just I find properties and I look for ways to add value that others have not been able to do.
Beautiful. Well said. Absolutely. So when we're analyzing a property, and don't worry, we've got just a handful more slides, and then we'll take some questions and things like that and have more of a conversation. But I think it's really important to consider how you do analysis. And this is like obviously not all of it, but really in reality, there's about 2 key performance indicators, other than all that other analysis that I mentioned, of course, your market research and whatnot, and due diligence, like you're getting all of the rent rolls and all of that good stuff. But for the most part, this cap rate concept and using that net operating income, and then your price per door. And a price per door is simply the purchase price divided by the number of doors, the number of units, the actual, apartment units. And that is a really cool metric because it can help you create comparisons more effectively. So for example, let's say you're looking at a 20 unit apartment or a 50 unit apartment, and you're using, that's a $70,000 per door, because then you're able to not evaluate the price of the entire building. Of course, a $50 million, a 50 unit, apartment is going to be, a higher price tag, but it might actually be a lower cost per door, a lower cost per unit. So that's a nice benchmark as well. Noran, do you use both of these?
I use both of them. I use more. Yeah, I use both of them. The price per door is a very quick way to look at stuff. I also look at cap rates, but I don't get caught up too much on what the building is trading for when I buy it. I want to know what will it trade for after I put my on it.
That is beautiful. We have a calculator in the Real Estate Wealth Lab, a member portal, about exactly that, what you're buying it for, and then your value add after repair values, essentially, and other value adds. And we've got a calculator for that. I did not include that right here. So that's something to go and check out, that calculator. But another calculator, go on.
So I was going to just mention, let's say that you wanted to go and you're new to the multifamily world. You want to get a feeling for buildings. So look at a building that, say, sold in the last 3 months, and just go, don't complicate it, go price per door. Let's say one building sold for $180 a door. 180,000, sorry, 180,000 a door. And let's say another one sold for 250,000 a door. Get the addresses, walk over, walk in, and just stand there for a little bit, and get and ask yourself, why would somebody pay $70,000 more per door for this building than that one? and you will see the differences.
Excellent advice. That's absolutely excellent. Boots on the ground, figuring out. And then if you want to bring your 180 up to the 270 or whatever, then you emulate that and talk to us and tell you what we've done. So that's great. And don't over renovate also. But anyway, that's a whole other another topic. But I would like to share just a fast filter. So if you're not familiar with this calculator, this can be really, really helpful just to do super quick math. You know, multifamily, expected purchase price, total gross monthly rent, 20 grand, pop that in there. And this property at a glance, this is a cash cow. And so if you can find, and it will tell you, this calculator will spit out if it's a cash cow, it's a super fast filter. It will also tell you to keep looking if it's not sufficient. That doesn't mean that, you know, there might not be a gem in there, but you may want to, or what you know that you could rent it out for after you do the repairs. You can think about it that way too. So just wanted to bring and highlight another calculator that we have, especially for our members. Now, when you're doing and looking at multifamily, there are other key performance indicators, and you're gonna hear these words and these concepts. However, for the most part, I don't really use too many of these in my multifamily analysis. I know many people who do, and many of them are REWL members and doing great, but it's not always that necessary. Some that I do particularly like, if I'm going to look at these, so you've got gross rent multipliers and gross income and effective gross income, discounted cash flow, net present value, cash on cash return. I know a lot of people use that. Your coverage ratio, and your profit per door. So those are kinds of some of the other ones. I don't know, do you use any of these, Naran?
I use them, but only to help me see a different angle, or if I want to know what the cash per door is, right?
Yeah.
But the big ones are net operating income, cap rate, and with that formula, I can do almost everything I need to, because all of these are spin-offs off that, or they're connected to that formula. It's all anchored in there.
Yeah. So anyway, I just wanted to highlight those. They're easy. I've got the, you know, anyways, moving on, you're going to hear them, but now we were talking about financing, Naran, a little bit earlier. And I think there's only like this and maybe one more slide. So just in terms of financing, we've got like what 5 units plus. Is that your experience of where the banks, the institutional financiers, etc., that they consider a multifamily? Is that correct for you?
That's
5,
correct
6?
for me. So this is a personal bias of mine. It's not an advice that should be followed like anything else. Okay, I don't like 5-unit buildings. I don't like 5-unit buildings.
Now tell us why, Naran. Tell us why.
Because it sits in that ambiguous line between, is it a multifamily or is it not? And so that same ambiguity goes down to the underwriter as well. And I limit the number of lenders that will want to fight for my business. So
there you go.
I like, if I'm going to buy, and a lot of times 5-unit buildings tend to be a house that's been chopped down into 5 units. I stay away from houses that have been chopped into 5 units, because the highest level of mortgage, and this is what was told to me by an underwriter, the highest level of default on a mortgage is in a house that's been separated into smaller units, because the renter profile it attracts has the highest level of rental default.
Interesting.
So some lenders will not even look at a house that's been split up unless it's like downtown Toronto, right? So a 3-unit, 4-unit house, that's fine, but it's a niche, like in a downtown Toronto type location, downtown Vancouver, it's a different animal. But I like to go, try a 3-unit building, or let's do 15 units.
Yeah.
I don't like the 5 or 6, but that's a personal bias of mine.
Well, but it's not just a personal bias though. I mean, you're making a case like if you want to be able to have more options for financing and more options for, you know, being able to sell it, because getting out or refinancing, all those things, it's hugely important. And I concur. I mean, I think my smallest was 8, but it was an exceptional, it was a beauty. It was a beauty of an 8. And then, you know, 10 plus is good. And I think my largest was 24 units. So, okay. So we align
Somewhere
on, oh yeah.
18 units is a sweet spot.
Okay.
Somewhere around 18 units, 20 units is a sweet spot because you have enough income to have an on-site super.
Yeah.
But most people do not have the access to capital to buy that. So buy the 8 unit all day long. Buy it, manage it. 5 years later, sell them all and buy a 40 unit.
Yeah, exactly. And Patrick's making a very good point of, you know, 5 units doesn't allow for economies of scale. Exactly. That's the other major benefit of multifamily is having economies of scale. 24 units under one roof is better than 5 units under one roof, and also property management on site, all of those things. And by the way, Hugh, I appreciate that. Yes, I just want to acknowledge property manager is worth their weight in gold. And if they're not worth their weight in gold, I guess one of the biggest mistakes I made in real estate was holding on to a property manager who wasn't good enough. It took me too long to truly assess the situation, and I was too long in, I'll just, you know, coach, keep them on, you know, try to be positive, and that damaged that property for sure. So good point. Also, not just they're worth their weight in gold, but they can also sink your ship. So make sure you get good ones and keep them. And if they're not good, find a new one.
Yeah.
So other reasons for like the financing perspective, we kind of mentioned this already in terms of like it's different qualifications. It's a commercial mortgage. So it's based on that asset performance, less focus on the investor. And a little bit of a myth buster. There is still a personal guarantee if it's in a corporation. So it's not like you're not on it, by the way. Like if you go and get a corporation and then think you're going to be a multifamily and not have some sort of skin in the game, no, that's not how it works. So I thought that would be a little good myth buster. Anything else on the financing?
No, as far as personal guarantees are concerned, one of the things that I've done is sometimes the lender will tell me I have to guarantee it, and I will have it added if possible. It's not always possible, but my personal guarantee is limited to the mortgage amount or something like that. That limits the liability. Sometimes lenders want, you know, everything.
So that's a whole nother what is it, ball of wax or something that we could go down.
We should do one on just real estate, on financing for multifamily.
Yeah, 100%. Because, you know, this is also something that for a fee, some high net worth individuals will actually be your personal guarantee for a part of the equity or part of and a fee and things like this. So that's just also another way. Like it might not even be you. You might need to be someone that is a super high net worth individual who wants into the deal, and that's a way to cut them in as well. And to also expand. And Hugh, you mentioned, for example, that you want to scale. Well, at some point, even the personal guarantee kind of runs out. So you get that, you know, source a high net worth individual who's interested in real estate, and they can lend their name to that. So that's a great way. And this is, I think, this is the last slide. So just in terms of offer, these things don't move fast. So in terms of submitting an offer and doing diligence, it's about 3 months. So, and then the other thing that you want to for sure is please do not put dates. Use triggers, thresholds instead in terms of, so for example, removing conditions. No way. Because if you're you're waiting on a rent roll, or you're waiting on utilities to come your way, or whatever have you, you've got to just avoid those dates, so that it's like, no, I have, 10 days after I receive, rent rolls or whatever have you. And in fact, I have all of those timelines week 1, what you do, week 2, what you do, week 3 in a presentation. And if that's something of value, again, that in and of itself is a 45-minute presentation, just the offer, the timeline, when you're giving out your deposits, how you meter them on multifamily. So that would be, so if that's something that you'd love, we'd be happy to go through that. Yes, please. Okay, awesome.
Jennifer, one thing I want to mention is that what you just said, I don't want it to be another thing that goes in one ear and out the other. Like that is true. I learned
Danielle
that
is
lesson.
saying she made the mistake of using dates once. So, okay. All right.
Danielle,
thanks, Danielle.
you and I have been in the same boat for sure, because I did the same thing. And then we constantly have to go back to the seller to change dates. It's just, if you, like you said, from the time we've received all the leases and rent rolls, 10 days after for due diligence on rent, or something like that, right?
Yeah. It's a whole process. Yeah. So, well, that sounds good that folks would like to have that. We are coming up to about an hour. So I'd like to open up the lines here for Q&A for any questions that we can take for maybe 10 minutes. And then Naran will pop back into the PowerPoint and share with some of our folks out there a little bit more about REWL. So questions, any questions?
Oh, Hugh. Can we bring Hugh in? Or?
Yeah, I'd like to.
Yeah. Hi guys, how you doing? Good to see you again. Yeah, so my question is, so I think I'm running into a wall in terms of personal finance, because I met with one of my mortgage brokers the other week, and he said you probably can't do anything on your own for a while. So I'm kind of at that stage now when I need to look at creative financing, I think, to finance my next deal. So, and obviously multifamily is something I really want to look into because of it allows you to scale and everything. So I think I'm just kind of at that stage right now. So I'd love to kind of just maybe get a few pointers about next steps and all that kind of stuff.
Yeah, absolutely. Well, thank you for asking the question. And since it's both how we started of hitting that financing wall and then popping over to more to, yeah, I've been doing a lot of talking. So Naran, do you want to go ahead?
Sure. So Hugh, great question. And here's how I did it. The first thing I did is that I realized that, and I gave myself a time frame to learn as much as I could about multifamily. Now, it depends on the kind of person you are. I tend to want to know stuff. So I started reading books. I started taking programs, courses. Like I just went into it. So it's funny. One of my business partners that we coached together, he and I were actually at a multifamily conference. On the way back, we set up meetings in the plane in the aisle, and we had meetings while it was in air, right? So in those what I found is that I had to get the right content. Next, I started creating at the same time a list of people, and I didn't make any commitment to them, nor did I tell them anything, but I started making a list of people that I wanted to develop a relationship with. And when I was developing the relationship with them, I asked two questions. One, do I want to hang out with these people? Like, do I want them to be my friends? Or do I want to leverage their knowledge? There are some people you meet, you just don't jive with, and you may not like them. You're never going to sit down and have a coffee or a beer with them. But you may want to leverage something that they have. So it's a pay per service. The more important question is, who are you going to build on your team? And what does that look like? And I started building that out. The next thing, the third question I asked is, what position do I want to play here? Do I want to do this on my own? Do I want to partner up with somebody that knows more than I do? Or do I want to just put my money into something and walk away from it? And once I was able to answer that question, it determined my next set of actions. Right? So
that is hugely important, Naran. Hugely important. I just want to kind of put a pin in that because that's so important. you made, and I'm not suggesting you, Hugh, necessarily, but broadly, like that question series of, do I want to do it myself? Do I want a partner? Do I want to not do it myself? Do I want to have somebody else do it for me and be more passive and I can still get great yield? Do I want to partner with somebody with expertise so that I'm not taking on all of that risk and the friggin' steep learning curve at the same time? And do you want to sleep at night? Because it is a lot when you're first foray. It's absolutely doable and you've got the right team around you if that's what you choose. But it's so cool to take that time and go, you know what? This is, quite frankly, I don't know, having known what I know now about multifamily, I don't know that I would have wanted to have expanded my portfolio in multifamily as fast as I did. I would have done it slower. I would have done it differently. Quite frankly, I learned a lot of very expensive lessons. And yes, it all worked out in the end and it was great, fine. But there could have been ways of doing it more effectively with that sleep at night factor as well.
So learn from our pain.
Yeah.
We have scabs to share, right?
That's right.
But the other thing is that in the multifamily game, Hugh, one of the things that I've noticed, and we don't, as investors, we don't really talk about this that much because we like to pretend we got it all together. But there is an emotional weight of moving into multifamily. It's one thing. Do you remember when you signed your first mortgage and you felt that emotional weight of what am I doing?
Mm-hmm.
Now imagine 10xing that. Like I remember the first mortgage I signed, we did I think our investment capital was $12,000, right? The last one I did, our investment capital was $2 million. There's a different level of emotional tenacity that you have to develop. And if you try and do it on your own, your fight and flight will sink in. And I find that investors, they'll reach a point where they find it difficult to emotionally manage it, and then they start hiding and or ignoring things that are amber lights, and they just start ignoring it, and stuff piles up in the back, and all of a sudden it will fall. So just partnership with somebody else is not just for skill set, it is for emotional management. It is for somebody to walk the road with you that has your back.
Yeah, I know that this is really real. Thank you, Naran. It's really cool even just to have this conversation because I've never talked about that, not at this level. And and then at every next level. So you start with at 10-plex and then the 24-plex, each one is a step. And I know an incredibly successful, super successful rock star in real estate investing. And she's shared this story, but I won't share who she is, but she is a rock star and buying a 200 unit apartment building is too small for her. Okay. All right. Like that. All right. And she'll share that she was on the kitchen floor, bawling her eyes out, dry heaving from the stress of each, so it is the reality. So it can be, it's not necessarily, but thanks for sharing that, Naran, because the emotional weight is important to consider. Does that answer your question, Hugh, in any way, shape, or form?
It certainly does. And that was wonderful. Thanks, guys. That was great. So that gives me something to start working on. But I think I try and approach this like anything else with, I know very little and I just want to learn.
So Hugh, here's a question I have for you.
Yeah.
When are you buying a multifamily? Let's put a timeline on this sucker.
Oh, God.
Getting real.
Oh, man.
Well, you're with the right peeps.
No, I know. I don't know, the next 12 months.
Let's do that in the next 6 months.
Okay.
Seriously, you're in the right room. We can make it happen.
Okay.
Okay.
All right.
All right, you all heard it here first. So in 6 months, we'll do a check-in with Hugh, and we'll be doing it before then, obviously, and working with you and collaborating. So that's fantastic.
It's terrifying.
And to help achieve that,
yes.
you just reach out to us. We'll outline the next steps for you.
All right, thank you.
Okay.
I will, absolutely. Thanks
Reach
so
out
much.
to Paige and she'll set it up.
I will. And thank you. That's fantastic. Thanks, guys.
Yay! I'm so excited. Oh, I love it. I love it. I see Maureen is asking a question. In the smaller markets, how has remote work changed your opinion on the local employment available? Has it changed the risk in buying multifamily in small towns? 100% it has changed it. However, this trend of moving out to the exurbs, if you will, so into the secondary markets and into the tertiary markets beyond even like, so for example, let's use the GTA, Toronto, GTA, and then Kitchener-Waterloo, that would be an exurb now. So beyond the suburbs, if you will, kind of. Then a tertiary town, then a secondary town would be more like the Chathams of the world, and a tertiary town would be more like a Sarnia. So that's how that kind of progression goes. And so small towns still, I've mentioned, I just want to make sure I reiterate that small towns should really, you should really be considering avoiding towns that are less than 70,000. Definitely less than 50,000. And for 50,000, that's because just like what Naran was saying earlier about, banks not really liking dealing with 5-unit apartment buildings or houses or whatever, but 5 units, what is that? Well, the same thing is towns under 50,000, banks need more information or they're a little bit less likely to do it. Doesn't mean don't, it just means be aware. And then this trend was happening prior to the government restrictions that were imposed due to the COVID-19 illness. And what people were moving out for affordability, et cetera, et cetera. And then of course those restrictions definitely exacerbated it. But what's happened is this remote working. And as a result of remote working, there's a lot of folks who aren't going to go back to the offices the same way that they did or part-time or whatever. So they'd be able to continue to be in those markets. And Maureen, I can tell you that what I did is based on that. It pushed up the market in a very significant way in some of those, because I was in the tertiary and those secondary markets. And I wanted to switch from being in multifamily for a long time. I wanted to switch into vacation rentals and a different clientele in a different market in the US. And so I actually took advantage of that at that high and actually, and sold a lot of my properties because it really did lift those. Now, that's okay because I wanted to deploy my capital elsewhere and, like I said, change a little bit of direction. So in other words, the answer, the very, very short answer is that yes, you can do really, really well in those secondary and tertiary markets, and it's fine. Just make sure it's got those economic fundamentals. And I just mentioned two markets that work. They absolutely work. So,
yeah.
Hope that
so
helps.
If you're interested in vacation rentals, Jennifer is definitely the person to talk to. Like she does this all day long and during recess as well. So it's kind of with regard to small towns, the only time when I would look at a small town is if it is a retirement town and there's a big push that there needs to be within a few minutes of that small town, a large city that's driving that. Sometimes people want to invest in a small town outside of a large city. But what I find is that the people that live there, they have nice houses. And the people that want to live in your little apartment, little box in the air, they can't afford to drive to the city. So you want to make sure that you balance those two out. So like in a small town, what I find is that seniors works really well, providing that you have a long horizon and a way to pivot if your market dries up.
Yeah. Any other questions? No? Okay. I'm
Vince,
just going to
do you
share.
have anything to say to us? We've got our Chief Technology Officer on here. Nope.
And
There
we go.
you are.
Oh,
How are you guys doing?
good. Technology officer had some trouble getting the technology stuff worked out to get himself unmuted. Huh?
Yeah, it wasn't unmuting. It's like, what's going on? It must be all the heat in Vegas here. It's hot.
Are
Boy.
you in Vegas? Okay.
Yeah, it was 107 degrees Fahrenheit, so it was pretty hot. So it's cooling down. I love the chat. One of the things that's key to me is the power team. Power team means so much, and I've done that. Also, the whole thing about been there, done that, learn from other investors, partners. Right now, just with off-market deals, I have about 5 multifamily that we're looking at purchasing just through connections. So through my property manager telling me, hey, here's a referral. I know that one person wants to exit, get a great deal like that. And just through connections, right? And you're right. If it's Jen, if it's on ICI, it's already too late, right? So it's all about off-market deals, learning, leveraging what other investors have done. And Hugh, definitely, there's a lot of people in this room that can help. But the power team is definitely key. And Naran, education. That's huge. So totally agree with what you guys are saying. But yeah, don't do it alone. I think that's probably one of the biggest mistakes I made earlier on is I'll do everything myself. Everything from drywall, plumbing, like you said, you name it, right? Cleaning, but time is money. And so is knowledge, right? So invest in education, get the right team, and win together. Don't win alone. There's no fun doing it alone. And I keep saying this, the people you surround yourself with is the people you're going to win with. And surround yourself with awesome people, and everyone should win, not just one person. So that's what I believe.
You know, and thanks, Vincent, for mentioning that too. And you know, that's something that I feel so grateful with the Real Estate Wealth Lab and the team that we have, you know, and how well we get along and how well we work together, and really in support of our members and educating individuals. So thanks for Naran for bringing Vincent out here.
Yeah, thank you.
Awesome. Okay, well, we're coming up like a full hour and a half, so I want to share my screen so that you guys can make sure that you register. Just a second here. I think that this is the right PowerPoint. Yeah, so that you can make sure that you register for our next event. And this isn't it. Yeah, here. So just a reminder for those of you who are members already, please, well, you're automatically registered already, but please come out August 17th to our next community lab. And the reason for that is because we are designing those boardrooms based on the information that we've already collected and how you want them in terms of rooms and breakout rooms by you know, individuals and different kinds of topics and all of that. So we're going to really get clear on that, which I'm excited, and get to know each other even more. And then at our next research lab, obviously we are now going to have the city market level analysis of Atlanta, Georgia. So Hugh, you'll obviously be at that, and anyone else who's interested in Georgia. And then September 14th, we've got Carmen coming, Carmen Campanero, Pro Funds, and just an amazing, wow, she's got this. So thank you so much. And then Naran, if you want to just take it away. And
thank you everybody for joining us today. I want to spend 2 minutes and just review who REWL is and what our offering is, so that if you are not a member, I would invite you to join us. I mean, don't wait, join us. Our top price for everything is $99 a month. Obviously, you're in this room wanting to make $1 million decisions. Don't scrimp on the 99 bucks. This is cheap. This is right. So make sure. I remember, Jennifer, the first time I joined a network, I walked into the room and there was this guy, and he was a black guy and he was wearing a 3-piece suit. And I walked over to him and I said, "You've been investing for a while." I said, "Would you join a group? Like, why can't I figure this out on your own?" And he looked at me and he said, looked at my name tag. He goes, "Naran, I've been doing this for 10 years. You can make a lot of money in real estate. You can also lose your shirt in real estate. Don't be the guy that loses the shirt." And I said, "Okay, I'm in." So I did not want to be that guy. So, you know, we have, if you are new to our community and you just want to take us for a test drive, we have a 14-day trial. And if you scan it, if you go to the next slide, Jennifer.
Yeah, I will. And sorry, I'm just going to add one more thing. For those of you who are members also already, totally understand we saved this for the end, but you may find value in being reminded of all that is available to you. So this may be something that you want to just carry on and share, listen to around. So there you are. Sorry, pardon me. I just wanted to say that.
It's all good. So if you just scan that QR code, it will take you to a 14-day free trial, just so you can get a feel for us if you need more than what we've given you so far. The problem.
And sorry to interrupt one more time, and then I'm going to be quiet. But Olu is wanting to be join us right now, so that's fantastic. Olu, welcome to the membership. The link is in the chat. Go ahead.
Olu, that's great, man. Thanks for taking action. You know what, Jennifer? I'm going to do something on the spot. Olu, you've taken action while you're here. Send a message to page info@realestatewealthlab.com. I will provide you a free consultation. Everybody gets a 20-minute consultation. I will give you a 1-hour consult. We can split that over 2 meetings if you want. I'll help you figure out where you're at and where you want to go. Okay, just send info@realestatewealthlab an email and just say I said this live, and Jennifer will hold me to it, and I'll do that for you in September.
Olu saying woohoo in a chat, so that's awesome.
Okay. Jennifer, what were we talking about? Oh yes, so the free trial here, there are problems that we solve if you're a beginner. If you can go to the next slide, Jennifer. If you're a beginner, you don't know where to start, we've got you. If you're experienced, but you want to, scale up like many of us in this room do, you're in the right room. And if you want to go to next level and you want to have access to deals and strategies and scale or exit a portfolio, so few, everybody always focuses in on the beginner. And that's important. The beginners are important. I used to be one, and some of you are. I've got you. But how you exit is important, because you want to exit in a fun way as opposed to in a painful way. So we've got that. One of the things I want to highlight is the amount of stuff that we put out. Jennifer, correct me if I'm wrong, but this is the research analytics that we send out. How often are we sending this out?
Yeah, so we are, this is we've got 2 market research products at that city level, if you will. So we've got one that's a little bit deeper dive, and then we've got one that's a 1-pager. And we're just about, I can't quite, but it's coming, and it's coming, it's gonna be really, really rapid fire. And I'm very excited, but I don't want to commit, but it's coming very, very soon. And I'm really expecting that basically you're going to get a lot of research. So buckle up.
Perfect. There's also a members only intelligence newsletter that we put out. And if you move ahead to the next slide, one of the things that you will find is that in today's market, especially, getting to the right deal or in front of the right deal is difficult. We have done some, not all, but some of the hard work for you. We found deals that we think we would consider. Now, you still need to do your own due diligence and run your own numbers. But on this page, on the property shop, we will have deals as they come in. We will vet them and we'll put them up. And it just helps you have a smaller pool, but a much better investment pool that you can reach into. Especially in today's market, because I'll tell you why. Inflation is continuing to go up. And given today's market, all the big players, myself included, Jennifer included, we are moving our capital as fast as possible into a hard asset like real estate. Like we are, because that is the only thing that's going to outpace inflation. At least that's my personal opinion. For industry professionals, $9 a month, and you get all of that. Let's go down a few slides for the beginner one. $19 a month will get you, this is for beginners, and it will give you the members only intelligence newsletter. It will give you the quick facts. It will give you an introduction. And if you step up to the $49 one, you get, and this is, if you're not a beginner, if you're an advanced, don't show up for this. If you are a beginner, this is where you show up. You'll see my face and Wendy's face there. We do how to get started in real estate. It's a course plus coaching, and it's about 10 weeks long, 10 sessions long. Our cohort, we'll be ending sometime in, I don't know the exact dates, but sometime in September, in the second week of September, and we'll be ready for another group. So if you want to join us, you feel free to come join us.
And scan the QR code too. There's QR codes throughout. And if you're wanting to just do this really fast, that's something that you can do.
Yeah. And what we can provide for you is what to do step by step. And the reason we can do it, Jennifer, if you just move to the next slide, the reason you can do this, we do this, is because we're in the trenches with you. Like, we are all, like Jennifer, Vincent, myself, Ken, Richard, we are all investors in real estate in real time. So we have tenant issues we're dealing with, bed bugs we're dealing with, financing problems we're dealing with. Today I got rejected on 2 mortgages. Right? So I know the pain of it. So we're in it, and we are constantly assessing it in real time. One of the other things I want to note is that when we start doing real estate investing, and I'm sure this never happens to any of you, it happens to me. I put everything into an Excel spreadsheet. I figure it all out, and I go, this is a great investment. And I show my partner, and they're confused by it, and they don't know what to do. If you go to the next slide, Jennifer, if we avoid using confusing spreadsheets, we've got, what do we call these? Calculators, right? That you can do. And what I love about them is that once you've done your spreadsheet, you come and throw it into the calculator. It will print out for you a nice, pretty piece of paper that will look way more professional and make you look much better. I want you to go move ahead 2 slides for me. Under one of the things I want you to notice is the width and the depth of expertise we have on our advisor panel. And this is just 8 of us. There are a few more that we have that are real estate investment advisors, for example, like Louis and Wendy. And we are all experts in different areas of real estate. I don't think I've ever been in a club that has this much of expertise under one roof. So if you are not a member, come join us. If you are a member, keep hanging out with us. And I know that the next year, maybe 2 years, next year for sure, is going to be very up and down. It's going to be confusing. We've got you because we're in the water with you. We're in the pool with you. We're all right. And and we're good swimmers. Yeah, absolutely. So $99 a month for top tier, cancel anytime. Any questions for me?
I hope that was a great overview for everyone too. And so I appreciate so many of you staying on too, because there's a lot at your fingertips. And for those of you who haven't gone into the member portal or checked on calculators, like I think there's probably like between 60 to even 100 calculators. I don't want to exaggerate, but let's call it 60. There are so many calculators. So if you need orientation and you need support, just email us and we will set up all of that for you. So I'll pop that in. Oh, thank you so much. info@realestatewealthlab.com. Get in touch with us. Thank you so much.
Any closing comments?
Any closing comments from me? I just like to say I'm super grateful for the community and the Real Estate Wealth Lab, and for all of the folks who come out and and to winning together, you know, and that's what I really find, you know, there's a lot of opportunity for us to work together, to collaborate, and everybody can win. And you know, Danielle, I know I owe you a spreadsheet. I think I'm waiting on your email, but so it's good. You know, we're working together. I think that's fantastic. So thank you. How about you, Naran? Any closing comments?
You know, like if you turn on the news, it's very confusing. Governments are falling. Money is a threat. There's a lot of stuff going on. And we're also going into elections coming up in the next little while, next couple of years. So I call it the crazy time when people make promises.
In Canada, and in the US it's right now coming up. Go on.
That's right. So we've got all this stuff going on. The biggest thing I've really appreciated from our group, Jennifer, is that we are all, like I said before, we're all in it. We are in it, we are crushing it, and we're also getting really struggling with some aspects of real estate and trying to figure out the market. So we're in it with you. We will lead with you, and we will work with you. So come join us. If you haven't joined us, stop putting it off. Just send us an email and, you know, scan the QR code, come join us. I'm hoping that in September, we can all get together somewhere, at least in Toronto. Okay.
Sounds good.
Okay. Have a great night,
Awesome.
everybody. Thank you for joining us.
Thank you, everyone. See you next week, please. And just join, as Bod said. That's awesome. Exactly. Thank you, Bod. All right. Take care, everyone. See you next week.